We have a great guest joining us today to discuss the markets. This is Mark Fisher. Mark has been trading for nearly 40 years. He's an influential member of the futures industry at large, a globally respected professional trader, a guest speaker at industry conferences, and the best-selling author of The Logical Trader. Thanks for joining us, Mark.
Hi, Mike. How are you?
I'm great. I'm great. Very happy to have you on and talk about the markets. So unfortunately, it's kind of a quiet day so far. Not a whole lot going on. Equities are up a little bit. Oil's up 2% on lower Saudi output, it sounds like. But what are you looking at these days?
I disagree. I don't think it's a quiet day. I think it's a very important day. I think if you see what's going on, there's a war going on, but it's beneath the surface. No longer are we, sending in troops or sending in missiles to different countries. Now we're conducting an economic war. Iran, the real in Iran is down 80% in value in 1 year. Venezuela's currency is destroyed. And I think now what the U.S. is doing is now starting to use its economic warfare influence as opposed, monetary warfare as opposed to, military warfare. And to me, that has long-ranging implications. One of the reasons why gold, I think, overall has been such a bear market is because Venezuela, the only asset they have left to stabilize their economy is by selling off their gold reserves. So if Venezuela is selling off their gold reserves until they're done, which way is gold going to go down? Straight down, right? And that's what's been happening, no matter what happens in the world. And so basically, and Iran and all these other countries that, if you're sitting in Iran and you're watching your currency depreciate by 80%, what are you going to do? Well, you're going to run to gold too, but the market's not going to let it be that easy that they're going to let you just go ahead and switch out of, a depreciating currency and hopefully the gold is, the savior. So I think, even though all the specs are short and trade is long, for lack of a better word, I think some point in the near future, when Venezuela is tapped out of what they have to sell, okay, and believe it or not, when the Iranian situation gets better, not worse, I think you'll see a massive rally in gold. But until then, no. That's the first thing. But it's interesting to see that the markets in crude oil are up so much. Everyone knew these economic impositions were coming into Iran today. But now I think, as before, there's going to be less conduits for Iranian oil to go out of. And so I don't think the United States and other countries are as opposed to, $70 oil when Iran can't participate. Because again, remember, when the U.S. is now a net exporter of oil, not a net importer, if you take everything into account. So I think that there's some stuff beneath the surface. I think that obviously the markets feel that the safest place to put your money is the U.S. stock market. I think people realize that, the people view that there's more risk in the U.S. debt markets than there are in the U.S. stock market, especially with earnings, projecting to some crazy number for this year and maybe even for next year. And I think that so many people, including myself, have lost money trying to, pick the top in the, in the stock market, and instead of waiting for a day when this market is down, on a daily basis, let's say more than 4 or 5% in the afternoon, not when you walk in at 9 o'clock in the morning and, and everyone's buying it. But, if the market's still down at, 4%, 5% in the afternoon, well, then when nobody wants to sell, because they say, well, how can you sell it now when it's down 7% is when you should sell it. Every other time when the market comes in 1% lower or 0.5% lower, I mean, think about this. People have tripled, quadrupled, quintupled their money. So what does 1%, 2% mean? Nothing, and if you look at what's going on in the market, it seems like, again, that the U.S. stock market has become, the less risky way to return of capital than any place else.
Well, I think that's exactly a key point that, if you look at, and that's one thing I was going to dive into later, but, one great thing about Marcus, he always dives right into the key facts, and, that's a great thing about him. But exactly that, what you just pointed, U.S. equities are up a little bit for the year, doing well, volatility is really low, but we've had great moves in energy, commodities, emerging markets. China's down nearly 20%, and it seems like, in a way, the money's just flowing to the U.S. as almost like a safe haven into U.S. equities.
Right. I mean, again, I think that there's going to be enough of an opportunity. Again, how high is high? Who knows? Can this thing go up another, can the markets go up another 10, 15, 20%? Who knows? Why not? But the way to, if you're going to get short, the way to do it is wait for an afternoon when the market's down more than 4 or 5%, and then get short. At least then there's a sense of panic. Here, every morning the market comes in 2%. It's the world looks at it as a buying opportunity. you know, and especially if their markets are not doing well. It's sort of like, and with earnings, you know, are all, at all times high for the S&P 500 and everything else. It just, you know, it just looks to me like, you know, it's a fool's game just to go ahead and keep trying to pick a top. In energy, on the other hand, you've got a whole wild card going on here because, you know, everyone's been, I listened to the speaker last week, the young lady who was talking about natural gas. What was her name, Mike?
Bryn Kelly, she did a great job.
Right. And she did a great job, but she's espousing what everyone else in the industry knows. Everyone thinks now because natural gas is never going to go back above $4 or $5, that because there's so much congestion at the hub that the basis markets can trade hard, but natural gas can't. That the market's been lulled to sleep. Whenever the market's been lulled to sleep, you know what ends up happening? Something happens that the market doesn't expect, and I don't know what it is that jolts the market, forward. To me, natural gas is the sleeping giant. When it awakes, I have no idea. But we've gotten so accustomed to these low prices that's, I don't know what the catalyst is going to be, but with the rest of the world paying significantly higher natural gas prices, I think that something's going to happen one day, whether it be pipeline issues, or it's going to be tremendous LNG exports, or it's going to be a tremendously cold winter, that we're going to wake up one day and you're going to see prices that are much higher than everyone expects, just because the sentiment index is so bearish. The whole world, my 3-year-old says every day to me before he goes to pre-K, he goes, Dad, just remember, not sell natural gas on a rally. That's the mantra of the whole world. It just can't work.
You've taught him well.
Well, never too early to start. But seriously, there's so many interesting things going on in natural gas. For instance, like this last move, when August went off the board, August had a rally the last 2 days because, again, when people have to step back and think, okay, when August goes off the board, it's going off the board in July, obviously, and it's for pricing for the month of August. And do you really want to be the person to go home working for an energy power company and go off the board short natural gas at $2.70? Is that too cheap? And that's the way we look at it. In the last 3-4 days of every trading month, do people want to go home short that market, for the month, in that way? And what typically happens is you see a rally in the last couple of days of the month because people who are traders don't want to lose their jobs in case something crazy happens. So there's an artificial push to the upside into expiration. And then come expiration, the minute the next contract becomes prompt, the market sells off, which has happened, a lot of the times. So beneath the surface, there's a lot of stuff going on. I don't think you can get lulled to sleep just because, the S&P just grinds its way higher because crude's up $1, 28. But I do think that the way the energy markets, the safest play has been this whole year has been to go ahead and to trade the front month spreads, which means by that to be long the front month, short the next couple of months, and capitalize on the backwardation that's going on in the markets. And I also think that that's going to continue for a while. I think that's what OPEC wants, and I think that also, by going ahead and keep selling the deferreds, it keeps the producers, from increasing production dramatically because they just keep selling it. So either you can be long the backs and just let them roll forward, or you could just go ahead and short term buy the product spreads, buy crude spreads, even buy nat gas spreads sometimes, and buy the front and sell buy the first month, sell the second month, sell the third month at times. But I think there's a lot of stuff going on here. I think that the agricultural equities, for lack of a better word, are probably a good call option to buy because if something does happen with China and we do get resolved, the grain markets obviously take off, but that's a risk reward trade that I don't think I want to make. But in terms of being long the grain equities, I think it's an asymmetric return of probably 3-to-1 to the upside. And I don't want to really go into which ones to buy because I leave it to who's ever on this call to figure out which ones to buy. There's a lot. I think that even though typically people are in the Hamptons, people away, people in Europe this month. It's not all of a sudden they just turns on the machine after Labor Day or around Labor Day and gets started. Everyone who's smart figures out what everyone's going to do before Labor Day and puts it on before them. So
I wanted to give you one update. So Bryn just made a comment and she said, I believe that's why I said converting futures to swing swaps at expiration has been the play in natural gas.
Well, yeah, because those 3 or 4 days actually, you know, during the month, the cash markets have done well. But the problem with trading the swing swaps is they're not so liquid. To me, you know, I still, I'd rather be long. I pick my spots to be long natural gas in the last 2-3 days of the month, especially because what people don't realize is there's a speculative cap on how much you can be long in the last 3 days a month. So, for instance, during the course of the month, anybody can be long basically anything they want, a fund, anything. But in the last 3 days of the month, there's a spec cap of 1,000 contracts. So whether you're Mark Fisher, whether you're Mike, whether you're Larry Benedict, whether you're anybody, whether you're ExxonMobil, unless you have a hedge exemption for some reason, you can't be long more than 1,000 lots in physically delivered natural gas on the CME, which opens up a lot of opportunities because then you really see what's going on. A lot of the specs move already to the next month because they don't want to be capped by 1,000 lot constraint. So.
Yeah, that's interesting. And, that actually, what you just pointed to, actually, I had a few questions, and that one is a bit later on, but I might as well just bring it up now. And so you mentioned a lot of people have been playing the spreads of short the front, long the front, short the back. Is that something that's been working out well, and is that something you think will continue?
People have been making money being long the front, in short, long first month, long second month, short third month, short fourth month, being in a butterfly, being long first month, short second month, long third month, the ratio. I mean, even look what happened with crude oil when this whole Syncrude issue happened, where, Seppak Novi crude oil went to some ridiculous level that's never been seen before. I think Seppak Novi went to like $2.30 at one point, which has never been seen because, again, no one's prepared for these, for these butterfly moves that happen. I don't think, and I think the risk reward time is pretty good.
So what other themes have traders been doing? You manage a lot of different traders. You speak to tons of different traders, not necessarily even in the energy side. What other trades have been working well for traders over the past 3 or 4 months?
People, believe it or not, have still been selling volatility in equities to the downside. People have been selling protection every time the market comes in low because it's been working. I think the place where people have been most screwed up is in the debt markets, because nothing's made sense. And things that don't make sense can continue not to make sense. I saw Jamie Dimon just came out and say he thinks the 10-year note should be 4% or maybe even 5%. Okay, I mean, I don't really know if it should or shouldn't, but there's so much money on the sidelines and so much capital that's just looking for a safe, a risk-free return that 4%, 5%, even with GDP at 3-4%. I mean, pension funds would lock that money in all day if they got to 4.5%. I think.
Absolutely.
And that's probably why it doesn't go there.
I mean, when you look at the global landscape of fixed income, we're getting to levels that they're starting to become slightly more attractive to even just park your money in cash.
Right. So, like I said, I think that August is a good month to trade in, because a lot of the people that normally in the markets aren't there, and you can get a moving picture of what's going on a little better. But again, what do I know?
Yeah. Well, let's come back to the markets in a second. I wanted to talk a little bit about the index that you've been very active in over the past few years. You created an index called the Essential 40, which is an equity index, an ETF, which is a basket of names that is, I guess I'll let you take it from there. If you could tell us more about the Essential 40.
Right. Well, first of all, it's not an ETF. It's an index that I created, and we license that index to various parties, including a mutual fund. But what the index is basically made up of a broad list of stocks based on weightings, based on personal consumption, GDP, and other factors, where the commonality between those 40 names is your life is materially, how do I say this, messed up, to put it mildly, if the particular company or the industry that it represents, has a material hiccup. So, for instance, if you look, I don't think there are many ETFs that have JP Morgan, Microsoft, and Verizon in the same basket in terms of the ETF world. I think about what would happen to a person's life if JP Morgan was to, God forbid, was to go out of business today, or Verizon, or Microsoft. And that's why those three names are in that basket. And we've gone ahead and that basket has been pretty successful over the last, 5, 6, 7 years. This year we're down about 180 bips to the S&P, which is unusual, but it's okay because we've had 7 stocks actually, that are down, over 10% for the year right now, outright. So with 7 of the 40 names being down over 10%, and us only underperforming in terms of indexing by 180 bips, it's not how much money you make when things are good; it's how much money you don't lose when things are bad. And I think that's been relatively for us. I'm okay with that. But again, the test of it's going to be when the markets go ahead and again, it's when the market's correct. My thesis is people don't sell things they need. People don't sell things they rely on. People don't sell things that they can understand. On the way up, they may not be as attractive because they're not as growth oriented or speculative oriented, but it's really more of looking at the markets 2 years, 3 years, 4 years, 5 years down the line.
So ultimately,
we've had some big losers in there. I mean, like GE has been a big loser for us this year again, and we decided to keep GE in the thing because until they divest, they were still in our period, for lack of a better word, too essential to fail. Now with all the divestments that are going on, we're going to have to look at whether or not we replace it or not, come beginning of next year.
So you set this up because you were saying this is what the Dow in a way was started, when it was started, this is the idea of the Dow Jones, but it's moved away from that now. This is a more modern version of that.
Right. Well, the Dow when it started in 1928, it really represented the industrial, it represented what was really essential back then. But over time, it lost its relevance. And basically now, our index is, equally weighted every year. We re-weighted back to 2.5%. Everything is re-weighted back to 2.5% the second week of January. And basically, what we're doing by doing that is think about what you're doing. If you're re-weighting back to 2.5%, assuming no changes, you're constantly selling your winners and buying losers. So you're hindering performance. But by doing that, okay, we're not like the Dow Jones, where the Dow Jones makes no sense to me because all the weighting of the Dow Jones is not even by equally weighted or by market cap, it's just by price.
Right.
So you got stocks in there like, you've got, I don't know, Goldman Sachs being, 20 times the value of everything else just because Goldman Sachs is,
a $200 stock.
$200 and something else is 20,
Exactly. So take me through, you mentioned before GE, so what's the process on possibly replacing a name in here? And give me a few names that were kind of, when you were putting this together, close call list of just being left out and, things like that.
I can't really tell you what names are, but we've made some changes this year. And I can talk about what we've done, but I can't really talk about what we haven't done. Okay, so let's take this year. So as an example, this year we substituted Chubb for AIG. Okay. And we did that, in January this year. And why was that done? Was because we felt that number one, AIG, after all their divestitures, and after all, one, because of all the divestitures, two, because of an insurance reason I'll get into. Okay, we felt that AIG was no longer essential as compared to Chubb. One of the things we looked at is after the terrible hurricane season and all the weather we had in Texas and Florida last year, we polled a lot of insurance companies and said, if AIG went out of business, how would that materially impact your business? And they said it would be a hiccup, but we'd survive. And then we asked the next question: if Chubb went out of business, how would that affect the personal, your personal lines of business and hurricane insurance, excess liability, all that stuff? And they said it'd be a debacle. So one of the things we look at is, remember, everything's arbitraged down in terms of PEG ratios and growth ratios. That's not the point of this index. This index is to go ahead and generate what's important to the way, Mike, you and I live in North America, and what's essential to the way we operate. And the testing that we've done also is that you could take the same baskets of the way of weighting that we have, and take the same idea, take it to, let's say, the Far East of Japan, pick 40 names there that represent, and you basically, you notice you have the same outperformance over time. You could do it in Europe as well. So again, the concept of essential, which is a concept that nobody that I know has really caught on to, is something that I think over time is going to go ahead and outperform in the long run just a typical basket of the S&P 500 or derivative of that.
Yeah, very interesting. And so, when did this index start?
We licensed it to we started a number of years ago, and we've been actually trading the components of the index myself for, let's say, we licensed it to an index as of last September, to a mutual fund as of last September.
Okay. That's great. Well, we're definitely going to keep an eye on it, and at the Opportunistic Trader, we'll definitely keep an eye on the index itself and track, how it compares to the S&P and different things like that.
Right.
It's very interesting. So let's get back to the markets as a whole. I see a few questions starting to come in, and I was wondering if, I guess, getting back to what you were talking about with energy, are there any specific names, or you mentioned before agricultural equity names that you might be looking at if the tariffs calm down, things like that? Is there any?
No, I'm saying I would buy these agricultural equities before the tariffs come down, because if you buy them after the tariffs come down, it's going to be too late. So I think you got to buy these now. And if you look at the charts, some of them are broken out already, because if and when these tariffs get these stocks, I think are moonshots. But I don't want to really recommend specific names, because if you do that, then
Yeah, absolutely.
I'm going to get yelled at by one of my attorneys. So I'd rather just leave it like that.
No, exactly. But that sort of sector, that's interesting.
Right.
What about on the commodity side? Is there anything into the end of the year that you're focused on? And then also, just following around with natural gas, I mean, what do you think could be a catalyst to get it to stay above $3?
I think that just one, bearish sentiment. I think two, it's going to be the same thing. Same way that in the S&P. Remember how I keep telling you, if the market's down 4 or 5% in the afternoon, then you'd sell it, not in the morning. Well, if natural gas was at some point was to have a rally of 20, 30 cents, and was able to maintain those gains going into the last hour of trading, right? Then you probably for the first time see people panic. So again, and again, if you think about it, if the market's up 20, 25 cents late in the day, who wants to buy it? Nobody, right? Because it's already up 20, 25 cents. What am I buying, right? But that's the right time, because when people don't want to buy is the time you want to buy, right? So again, I wouldn't look to pick the bottom. I'd look for something to happen where the price moves, and when the price moves, just figure out what your risk reward ratio is, and just and do things that are outside your comfort zone, because that's how you make money. You never make money doing things when you feel comfortable. It never works.
I don't have the volatility graph in front of me in terms of natural gas, but how does that look? And is there any interesting plays based on that, just volatility alone in natural gas?
People have made money just selling the straddles. Every month people have just been selling the at-the-money straddle and collecting the premium, and just rolling if they haven't. And it's been successful for a while. I think that come the winter, if you don't have access to trading, the next day, the cash next days, you can look to put on, front month spreads for a couple of days if you don't feel comfortable trading outright. But I think that the market is so comfortable with just saying the price is never going to go up, that something's going to happen that's going to make it go up. It's sort of like, I think everyone's gotten way, way, way too comfortable. The sentiment is so over, like I said, I don't want to repeat myself, but if you ask 99 people out of 100 would say, natural gas can never go up.
Well, our next webinar, actually at 1 o'clock, is with Adam Collins from Movement Capital, whose sole purpose is really looking at sentiment and dissecting those sort of things. So we'll definitely take a look at that as well, and I'll ask him about that. But it seems that way as well, definitely, for a number of years now. I mean, I guess about 10 or 12 years ago, we had a big spike in natural gas above $10, but since then it's been a straight move down.
Well, that's exactly what happened. When the market was trading $14, $16, it was crazy. Then, as the market went lower, people were afraid to be short, because people had a memory of what happened when the market rallied. Someone was afraid to get, to be short, because they said, okay, well, the market's come up from 14 to 10 to 11, not 11 to 10, but I'm afraid it's going to go right back to, it's going to have a gap back. And so that's why the market, as the way down, just kept going lower. Now, nobody wants to be long. It's the exact mirror image of what happened back then. And if the market went up, people won't get long because they say, well, you know what? Okay, Chesapeake got big deal. Every other time it goes back down, so I'm not going to get long here because I'm just going to lose money because the market's eventually going to go back to $3, just like just like it did the last thing. So the catalyst to make it going up is the same catalyst that made the market going down. Sentiment. Nobody wanted to be long. Nobody wanted to be short at $12, $11, with maybe exception of Larry Benedict, okay? Because everybody was afraid of what would happen to the upside. Now no one wants to get long because everyone's afraid that every move dissipates, and you're just going to lose your money. So it's the exact opposite sentiment.
Yeah, for sure, and it's absolutely. Somebody asked a question here. You mentioned earlier that you, when talking about the equity markets, when things were quiet, things like that, you mentioned that you faded the equity markets a few times. What were the catalysts that you took the short position for? Like, what was the catalyst for why you might have shorted the markets over the past few months?
In one word?
Sure.
Stupidity. Okay.
But at the time, there must have been a thought in your head other than that.
Yeah, but I can give you a rationalization if you want, but looking at it objectively, it's stupidity. And also if you look at something else, interesting enough, if you do a behavioral thing, especially with my traders, people walk in every day, and I don't understand why this happens, but they want to sell things, whatever it is, stocks, bonds, commodities, grains, currencies. Whatever it is they want to sell, okay? And the reason why people want to sell things is typically they walk in. You never hear someone let's say that had a bad day, a bad weekend or a fight with their wife come in and say they want to buy something, right? Or their kids were up all night. They say, oh, let's go ahead and buy everything. Typically when people have personal issues, just like, whatever, a bad day, everybody comes in with the attitude, let's just sell. Why? I have no idea. But some psychologists should do a study about that because that'd be an interesting thing. Right?
I agree with you. Actually, we have our trading psychologist on Friday, and you make a very good point because you're right. A lot of people, for whatever reason, if they want to sound smarter or what, they tend to say, they want to sell something.
It's not smarter. I think that if you're driving in New York and you're stuck, in a 5-hour traffic jam, or you're in the Jersey Turnpike, stop in a 6-hour traffic jam, the next morning, for whatever reason, your inclination is you're going to let that 6-hour traffic jam. You're just going to sell whatever it is. Why? I have no idea.
Maybe looking to outperform somebody else or an index or.
No, I think you're just looking to I don't know. People just, I don't know. That's for your. Maybe you should ask that question on Friday to your trading psychologist.
I will for sure, and we'll let you know.
Right.
So yeah, I mean, you mentioned natural gas, energy, the spreads,
gold,
right? Gold.
Think about this. Are they really going to let Venezuela sell gold at high prices? Right? Or are they going to wait till Venezuela's down to their last, $1 billion, and then after they're liquidated, it's sort of like a forced liquidation, right?
But why is it that you think that gold hasn't rallied? Given at times over the past year we've had North Korea, we've had Venezuela,
I think because Venezuela is a forced seller, and the whole marketplace knows that. And they know that they've got another 8 billion, 7 billion, 9 billion, who knows, of reserve that they're going to have to sell to as long as they want to keep the country somewhat functioning, right? That's their only currency. So if you have to sell it, regardless of what the long-term worth of the commodity is, you're going to first, make them sell it and liquidate before you rally it. That's what's been going on. I think that's been overlooked by most of the gold, publications, and I read a lot of them. Is the force of you have a forced seller in any market. I'll give you an example. Let's assume that you knew that XYZ stock and it was doing great and had great PEG ratios, great growth, earnings per share, but you knew there was someone that had to sell, 5 million shares of that stock in the next week. No matter how good the news was, the stock's going down until the guy's liquidated, right?
Absolutely.
So what's the difference? Why is it any different than what's going on with Venezuela and gold?
That's a valid point because a lot of people have been scratching their heads on why the historical correlations haven't been working and a lot of reasons why gold might have popped, but it never has.
Mike, let's take one word out of your equation. You can ask Larry, you can ask most of the people here. When people start talking about historical correlations, what the hell does that mean, historical correlations? Those things don't work. If they work, then any computer would be able to just go back and do it. The reason why most of these AI systems work is because they're looking at stuff. Their historical context is what happened, 20 seconds ago, or 5 minutes ago, or 20 minutes ago, right? They're not looking back to 10 years ago, 8 years ago. Everyone looks back that far and says this time is like that time. It's like it can't work. The last time I saw a historical correlation really work is when Paul Jones nailed the crash of '87 versus the crash of '29. That was the last time I saw something like that really work.
Well, I think there have been some more recent cases, but I agree with you over the past few years that what you're saying makes perfect sense. But I think more, even in 2008, you could look at some correlations of whether it be S&P versus, let's say, Aussie yen or carry trades or things of that nature that were working for a short period of time. But at this moment, a lot of historical correlations for the past year, people are completely banging their head against the wall on that.
I think the one currency, and I don't really trade it, if you look at it, that makes no sense, but it's actually, been performing well. Just to let you know, is the Mexican peso. Everyone was afraid of that, whatever his name is, getting into power. But but about a week before the election, that currency, Mexican peso has bottomed, and the rhetoric that's been coming out of Mexico has been toned down significantly, and the Mexican peso has been outperforming everything. The Canadian dollar, the U.S. dollar, the euro, everything in the past, month and a half. It's sort of like interesting that you think that, the only person that can make peace is a warmonger, and the only person that can probably, make peace, I don't know, maybe is, someone like him. Maybe that's what the markets are saying.
Yeah, well, the peso's definitely been very volatile since the election, the U.S. election, with the president's rhetoric. But as you say, more recently with maybe some.
No, since the Mexican election, the peso's gone straight. Before that, it's gone straight up.
Right, right, right.
It goes back to the same motto. If anyone's listening, things that make sense never make money.
That's a good point. Well, thanks a lot for taking the time. I think you've provided a lot of great information, and you're going to be back on Friday, so people have further questions, thoughts, follow up.
And I'll get my thoughts from my 3-year-old on natural gas, and I'll let you know.
You've trained him well. That's the bedtime stories.
Well, I don't know if he ever goes to bed. That's a whole other nightmare, but whatever. All right. Take care.
All right. Thanks, Mark.
Bye.